Thanks, Anil, and thanks everyone for joining. So after a couple of years of lackluster returns, the global listed property sector has rebounded quite solidly over the last quarter, and in fact over the last 12 months, with global listed REITs delivering almost 29% total return, which is just a little bit behind global equities at 32%. And the most recent quarter, in fact, the global listed property market outperformed global equities with a 16% total return. And as you can see on the right-hand side of this slide, some of the segments of the real estate market that performed the strongest were self-storage and healthcare. And from a regional perspective, Hong Kong and Canada were both strong performers as well. Some of the conditions behind this performance is obviously, from a starting point, REIT operating conditions are quite solid. We've seen moderating supply with solid occupancy leading to good rent growth conditions, and also values of real estate are at or below replacement costs, which is an important theme that I'll talk about a little bit more throughout this presentation. And importantly, we have begun to see an easing of financial conditions, which is normally supportive of commercial real estate markets. And that was highlighted by the first cut by the US Federal Reserve this cycle with a 50 basis point start. Of course, we did have a bit of volatility within Asia. On the positive side, we had rate cuts and fiscal stimulus within China, boosting the Hong Kong market, while in Japan, the unwind of the yen carry trade and some geopolitical uncertainty did create some negative influences. In terms of the relative performance of our fund, we did see a little bit of slippage relative to the benchmark in this most recent quarter. And this is not unusual throughout the history of our strategy, given that we do have a quality bias. And we do often lag a little bit in the initial part of a rebounding market. And that's when you typically see some of the lower quality stocks perform quite strongly. But over the long term, our strategy has outperformed on an after fees basis with lower risk given that quality bias. And within the most recent quarter, the segments of the market that contributed positively was our overweight exposure to healthcare, where we continue to see strong operating performance. But at the other end of the spectrum, we had detractors from residential and from self-storage, and dynamics there interplaying with each other. As I mentioned earlier, US self-storage in particular has been very strong, and that's been in relation to market's expectations that the lowering of interest rates would result in an improvement in operating conditions for self-storage, which is somewhat housing related. And on the flip side, the residential market saw some weakness because the residential market has been benefiting from the higher interest rates and higher mortgage rates, resulting in affordability favouring rental landlords. And as interest rates come down, the market's expectation was that residential would be negatively impacted. In fact, we believe that residential remains very affordable from a rental perspective, and from a storage perspective, we remain concerned about the pricing power and erosion of pricing power following a normalisation of demand. They had excessive demand during COVID years. We believe that is normalising now. But in the most recent period, we did see the US self-storage names outperform quite strongly, and we were underweight that segment of the market. So turning to portfolio positioning, we have exposure to parts of the market that reflect relevant segments of the economy, including retail, 22% of the portfolio, residential, which we believe there's an undersupply of residential globally, healthcare, which is predominantly seniors housing and benefiting from the aging population, data centers, which I'll talk about a little bit more, and profile of stock in a moment, where we have exposure to, and logistics at 8% of the portfolio. And this is how the portfolio looks from a sector point of view, retail, residential, and healthcare being the three largest segments of the market. The biggest overweights relative to the benchmark being in healthcare, retail, residential, and also in data centers. And we're underweight industrial and office, and mostly because we're concerned in industrial and office about the supply dynamics, and in office demand, in industrial supply dynamics and demand, which are weaker than they have been. And from a regional perspective, about 60% of the portfolio is in the US and 12% in the UK. Relative to the benchmark, it is an overweight to the UK, but it's only 12% exposure in absolute terms. And you can see an underweight to Japan. The top 10 holdings are mostly in the sectors I touched on already: healthcare, data centers, residential, and retail. Turning to the operating fundamentals, which is absolutely important. Supply and demand are critical factors when we think about real estate returns. And you can see from a demand perspective on the left-hand side of slide 10, occupancy levels for the REITs is at record highs. And that reflects fairly strong operating conditions, fairly strong economy, and relatively muted supply, which is obvious on the right-hand side of this chart. The current level of supply as a percentage of existing inventory is notated by the red dashes on these charts. And you can see that retail and office and hotels have got substantially below long-term average supply being added to the market in the form of construction starts, with those red dashes well below the dark blue diamonds on those bars. The segments of the market where we do see elevated supply has been industrial and average levels of supply in the multifamily markets. But overall, one of the key things we're seeing globally is construction costs, and in fact all the inputs into development has experienced significant inflation, and as a result of that, it's much more difficult for developers to bring on new supply. And as a result of that, with solid demand and limited supply, this is leading to healthy rent growth in the segments of the market that we have exposure to, like healthcare, like industrial and data centers, less so for office, obviously with the structural demand question marks in the office markets, but certainly strong demand, a strong projected earnings growth in the order of 11% per annum for the next 2 years for healthcare, and about 8% per annum for data centers. Now, one of the things that we think the market is missing is what we call intrinsic value. When it comes to real estate, intrinsic value can often be broken down into a very simple component of the replacement cost, which is normally land and buildings. And you'll all be familiar with the significant amount of inflation that we've had in construction costs over the last 4 or 5 years. In most markets around the world, we've seen somewhere in the order of 30-40% inflation in construction costs over the last 4 or 5 years. Yet real estate values, commercial real estate values, are down somewhere in the order of 10 to 15% relative to their peaks. And so we've now gotten to this interesting point that doesn't happen very often, is that real estate values are either at or below replacement costs. And we think that's very supportive of values. Now, it's all well and good if you have reasonable supply and demand conditions, which we do, and if you have construction costs that are elevated and in fact above asset values. But if you have poorly structured balance sheets, that's not a great thing for real estate owners. Thankfully, REITs have fortress balance sheets. They've learned the lessons of the global financial crisis, and the balance sheets are in very strong position with decade-low leverage. A loan-to-value ratio of our portfolio is around about 31%, and long debt duration. So very little in the way of near-term debt maturities, nor very little in the way of, in fact, exposure to floating rate debt. And yet, as I mentioned earlier, it's been a couple of tough years, in fact, 5 to 7 years of fairly lackluster returns for global listed real estate. And obviously an environment where tech stocks have been gaining a lot of attention, the relative total returns from listed real estate have significantly underperformed the broader equities market. In fact, when we look back through history, the last time that global REITs were so unloved relative to global equities was in the dot-com bubble. And we all know what happened subsequent to that. Obviously a mild recession, but significant cut in interest rates, and some of the dot-com companies no longer around, and people began to get interested again in hard assets backed by real estate. Now, from a valuation perspective, we also see supportive conditions in a relative price earnings multiple perspective, with the global listed REIT market trading on almost one standard deviation below the mean in a relative PE ratio perspective. And easing financial market conditions are supportive of commercial real estate values. So as I call, with a 50 basis points cut this quarter, but we're also seeing fairly significant improvement in lending conditions from the commercial real estate lenders. And we're also seeing credit spreads narrow down from where they were only 2 years ago, 18 months ago. And so the overall cost of finance for real estate landlords has come down quite significantly, and the pathway forward seems to be even further cuts, which underpins asset values and transaction costs, transaction volumes as well. So I wanted to spend a moment or two just focusing in on the data center opportunity, because one of the things that people have been very excited about has been the tech companies more broadly, and of course, the word on everyone's lips is NVIDIA, and NVIDIA creates chips, and those chips need to go into data centers. And people often forget that ultimately all these NVIDIA chips need to go into hard real estate. So we've seen a significant increase in demand for data centers in an environment where AI is driving, is adding to the demand conditions for real estate. Even though it's early days, it is driving demand for data centers. We've already seen quite significant, many years of significant demand for data centers because of the digitization of just about everything and because of cloud adoption. And yet, as you can see on the right-hand side of slide 18 here, this is rents in the North American wholesale data center market. Rents were actually falling, and that's because interest rates were falling, property yields were falling, construction costs were pretty benign in that period from 2012 all the way through to 2021. But since then, we've seen inflation in construction costs, we've seen higher interest rates, higher property yields, and as a result of that, developers need higher rents to justify beginning a new development. This is a phenomenon that's occurring in data centers, in particularly in the wholesale data centers, which is leading to significantly stronger pricing power and inflection in pricing power for the data center landlords. We think this is very positive, but we also think these dynamics are occurring in other real estate sectors. As we've seen this construction cost being elevated across all real estate sectors, and as I mentioned earlier, relatively solid operating conditions from a demand perspective. And when it comes to data centers, we have two exposures in the portfolio, Digital Realty and Equinix. Very briefly, Digital Realty focuses mostly on the wholesale data center market, which is larger tenants, longer leases. Equinix focuses on the network dense or retail colo type of data centers, which are smaller tenants and generally more difficult to replicate. And both of these types of different data centers cater to different subtypes of AI use cases. Training, which is the area that's gaining the most attention, is the early phase of data center evolution, is mainly going to be in those wholesale data centers where Digital Realty is focused on. But ultimately, when end users begin to use AI, it'll be in inference, and that needs to be close to where the end user is. And that's where a network dense, high density colo facility like Equinix owns will benefit in the medium term. So Equinix really is a global leader in the network dense data centers. They have an $85 billion global portfolio in many highly densely populated locations, very often along coasts where there's key landing points for subsea cables, and these are very difficult to replicate. And as a result of that, Equinix providing that low latency value proposition has generated very strong pricing power over a long period of time with a good, strong track record of 10% per annum earnings per share growth. And we believe that's poised to continue for the next several years. So to sum up, we think that the global REIT market is poised for solid returns going forward, given that we have best-in-class operating platforms like Equinix and Digital Realty, who have superior access to capital in a market where access to capital is improving. Operations are sound, demand conditions are solid, supply is limited because it's very difficult to bring on new construction. In effect, replacement cost is above the underlying asset values. And so REITs are effectively valued at or below intrinsic value. And as a result of that, we see REITs as being a solid part of a diversified portfolio. With that, thank you for your attention. I'll hand it back to you and Neil. Thank you.